And welcome to the Prescribing Prosperity Podcast with your hosts, John and Alex Soutsos. Gentlemen, good to see you.
Likewise, Bill. Always great to see you.
Nice to see you, Bill.
So we're coming up on the end of the year here. Maybe a review of markets, where we've been, and maybe where we might be going is in order, gentlemen.
What a year.
It's been an interesting year.
It's been a very interesting year. Yeah,
Some things have happened.
A few things have happened in the case
of. Can we use that as the line? A few things have happened.
Yeah, a few things have happened. That's a good line. It's actually true, especially in the United States with a new administration in the White House, a new president, and here in Canada, a new prime minister, and a lot of turmoil in the financial markets, a lot of turmoil in the economy, a lot of turmoil in trade. So there's a lot to unpack. So we need to summarize it quickly rather than to get too much into the weeds, because I think most people already have experienced it, seen it, done it, been there, gotten the T-shirt, etc.
Oh, yeah, I think so. So it's a good thing I'm relying on you to do that and not me. So
I think, Bill, as far as the United States is concerned, I think a valid lesson has been learned by market observers, and that is that tariffs do not cause inflation. Tariffs are a friction on economic activity because essentially they're a tax. So if anything, they're disinflationary. We said this clearly and explicitly in our newsletter in the beginning of this year as the whole tariff phenomenon was unfolding, and we were correct. The principal reason we've had inflation in the United States and in Canada has been unfettered immigration, legal or otherwise, excessive stimulus during COVID, all borrowed, and interest rates that have been stubborn and coming down. At least that's the case in the U.S. And as always, the current Federal Reserve regime leadership has been late in each of their tasks to try and adjust the economy. I'm not a fan of central banking to begin with, to allow a group of people to make decisions about economic activity and to stick handle it and to try and make the economy perfect, I think is irrational. We heard arguments against that kind of strategy, central planning, for the entirety of my adult life, at least until the Soviet Union collapsed, because that was the argument. Free enterprise is better. Central planning doesn't work. Yet here in the free world, we continue to retain central planning as far as monetary policy is concerned. So they continue to create problems. So the big takeaway was the whole tariff scare was unnecessary. The market rebounded rapidly. And there was a lot of new activity in terms of laws in the United States. The one big, beautiful bill was passed on July 4th. Some of its measures are retroactive to January 1st, 25. Yet, many of U.S. consumers have not seen the benefit of those measures until their first paychecks in January of 2026. So we're going to see we're going to get into this a little bit later in the podcast, but we're going to see a lot of private sector stimulus going on in 2026. That'll be very beneficial to the economy. But in retrospect, in 2025, markets went for a big cycle, big down, then a big up, and we're ending up somewhere in the mid-teens in terms of the market valuations at present. Although since we kind of topped out October, November, and now in December, there is appears to be a material rotation beginning to trend away from some of the technology companies. We had this whole narrative of AI bubble and breaking, and which may or may not be true, but what I did not see is the media did not give adequate coverage to people or to institutions who disagreed with that narrative. And that would be mainly George Mason University, which published a rebuttal to the MIT thesis of the whole AI bubble, internal funding, cyclical funding. circular funding model. And so there isn't necessarily unanimity on this AI bubble, yet the media ran with only one side of the story instead of providing a balanced alternative version. So now you're seeing some money rotating out of technology, which I don't think is permanent. But certainly in the short term, there's been some fear. And we're beginning to see some movement into other sectors. And for the most part, you know what? That's a good thing. We want to see more of the 500 stocks on the S&P moving up, not just 7 to 15 of the big companies.
Yeah.
And that would be much healthier for the market.
Well, you know, just a really quick note before we go on, in an effort to keep us from going into the weeds, if any of the listeners have not read the George Mason University rebuttal to the MIT paper, please take the time to go do a little quick Google search and do that, because George Mason really did a very nice job at rebutting some of the fundamental arguments that MIT made about it being basically a lot of inbred money chasing inbred money and therefore making a bubble. And George Mason pointed out the fallacy of that argument. And I don't want us to go off into the weeds about that argument, but I do want to ask you about sustainability, John, because the market's been really volatile here. You're right. We peaked out like somewhere in October, right? And things have been a little bit bumpy ever since. You talked about rotation out of tech stocks, but what are you seeing in a broader sense?
I'm seeing some movement into financial services. Interestingly enough, one of the traditional growth sectors, consumer discretionary, appears to be holding up quite well. What's really encouraging is transportation. That transportation index is holding up really nicely. But there is a lot of movement into healthcare as well, or has been. It seems to be on and off, 1 week on, 1 week off. That's the frustrating part from a portfolio manager's perspective. You want to see a trend, and there doesn't appear to be a trend right now. From 1 week to the next, like I said, you get money sloshing between the growth and defensive sectors back and forth. And the biggest beneficiary of the defensive rotation has been healthcare, a lot of it in pharmaceuticals, biotech. So we're seeing movement away. Some industrials have benefited from the rotation away from technology, but it appears investors are. It's also the end of the year, so you do have some profit taking that's going on, window dressing, as they say, among institutional investors. So for all intents and purposes, this weakness right now may be very short-lived. Santa Claus rally traditionally is December 21 to the end of the year. We're now December 17th on the date of this recording. So a lot of the rotation out of tech may wrap up in the next few days, and we might see some of the traditional year-end strength. But just quickly going back to the MIT George Mason University, in our newsletter, I presented both arguments in a table side by side. So I encourage people who have an interest in this to send us an email, contact us to request that newsletter, and we'd be happy to provide it.
Yeah, that would be great. Really quickly, what about, to stay with this theme of rotation and what you're seeing, I'm thinking of the Russell small caps, for example, John. They've had an extendedly bad period of time. There's an argument out there that maybe rotation into some of these small caps and value stocks would be in order this year. What are your thoughts or perspective on that?
I think small caps have, first of all, as you're correct, they haven't done anything for an extended time frame. Yeah. But the setup is optimal. You're going to have further cuts in interest rates in 2026, the magnitude of which we don't yet know. But given the fact that there's going to be a new chairman for the Federal Reserve, I suspect that we're going to get at least a 0.5 point cut over the course of the year, perhaps more than 0.5 point. And low interest rates are critical for small cap companies because they rely extensively on borrowing. Also, you need low interest rates to encourage mergers and acquisitions in all caps of the market. So I think small caps certainly do have significant upside, but as has always been the case, small caps, because they don't have the same liquidity as large caps and they don't have the same coverage, they tend to be quite choppy and volatile. So the question is, how much do you keep in your portfolio? And that's up to the individual investor. But in the case of our portfolio, we do dot the portfolio with some mid and small cap companies, but not a lot. We're focused principally on large caps, but certainly great opportunity in small caps for the right businesses.
And what about looking ahead? Because we are in a strangely geopolitically odd time. The Russia-Ukraine crisis is not getting resolved as many people thought or hoped it would be. We've got a situation in the Middle East which is edgy, I will call it, as opposed to saying downright destabilizing, because there are other forces at work in the Middle East for the first time that might mitigate that. But how do you see geopolitical events, John, and what lies ahead?
Okay, well, my crystal ball's at the shop, as you know.
Oh, it is? Damn it, John. You're supposed to bring it in for the podcast, buddy.
I forgot. I don't think they're missing a part. The supply chain is really problematic. It's still in China. Anyway, so the Middle East, I'm not an expert on Middle East geopolitical events. I do have my own opinions. You don't need a resolution of the Middle East situation or the Russian-Ukraine situation for markets to do well. This is a fallacy a lot of investors fall prey to. They go online, they read all these things about all the problems in the world, about the massive debt the U.S. has, and not just the U.S. Every Western nation has a lot of debt, and for that matter, so does China. A lot of people don't realize that. The Chinese government also has excessive debt. Mm-hmm. So they read all these things and they say, how can the market possibly be going up at these rates given all the problems in the world? Well, I've been in this business for 4 decades, and there's never been a year without a problem. There's always a problem. There's always something going on that's negative. Right. What you need are corporate earnings to be going up. And as long as corporate earnings, and keeping in mind that CEOs who run large corporations, their job is to manage the profit. So they want to make sure revenues are rising. They want to make sure earnings per share are rising. And whatever problems are going on in the world, they're adjusting individually within each company for those problems and the impacts they have on their corporate earnings in order to maintain a sense of profitability. And the companies that pull that off successfully will go up more, and the companies that don't will not go up as much, or maybe they'll even be bought out or go bankrupt. So you don't need a perfect geopolitical climate. I don't know if either of the two items you articulated are going to get solved in the next 12 months, but you don't need them to get solved in order for the economy in the United States.
But the geopolitical events don't necessarily need to be. They are not necessarily a backdrop for the stock market, but what they do act as is are catalysts to potential market volatility as markets react to geopolitical events, especially right now where we have a bit of a choppy market that's going through some volatility at the moment anyway, and it looks like the market is looking for an excuse to engage in a bit of a sell-off, given that a lot of the sustainability ratios that we follow are turning more short-term bearish than they are still long-term firmly in the bull camp, but in the short term they do look like they're headed towards the possibility of a correction. And sometimes what you need is a catalyst of some sort to give the market an excuse to enter a more negative mindset and sell off some of those securities. And sometimes a major geopolitical event can impact that, especially when it impacts something as critical as oil supply, for example, and that's a major cost input for a number of different industries.
Just to piggyback on that thought, the market's been dying for a revaluation of some of the expensive companies out there, and certain events and circumstances are providing that excuse, as Alexander said. Especially the whole AI bubble narrative has played into that. But understanding also that the stock market is not immune from manipulation from Wall Street. So Wall Street moves money around for institutional investors. And when the institutional investors were behind the curve most of 2025 because they missed out on the the rally following the tariff reversal, And retail investors, meanwhile, participated for the most part quite nicely. Not all of them, but a good chunk. And so a lot of institutional investors got priced out of some really high quality businesses. And so periodically, stories are released in friendly media to encourage people to be a little scared, sell off some of these high quality businesses so the institutional investors can get a better pricing to get in. And so I think some of that is occurring. And I'm not a conspiracy theorist. Anyone who's in the investment industry at a level of portfolio manager or up or slightly up or above that position understands this.
Oh yeah, I was going to say a lot of people don't realize this, but on Wall Street there's a buy side and a sell side.
Yeah.
And either one of those particular camps are going to make the arguments for whoever they represent, and if a sell side analyst gets a hold of a journalist ear, a financial journalist ear, they're going to preach that sell. And you're going to get an overrepresentation, maybe, of an argument, as a matter of fact.
This is why we actively discourage people from watching the financial press, which some people call financial porn. Kramer may be a very smart guy, but the way he jumps around his studio all day long and is banging bells and et cetera, that is a lot of entertainment. And even the PMs that come onto in the U.S., the financial shows, or here in Canada, BNN, when they're talking about any individual stock, they may be saying something wonderful about that stock, but you don't know their motivation for saying something wonderful. Maybe they're trying to bid up the price so they can get out. Or if they're saying something terrible about a stock, maybe they're encouraging people to sell so he can get in at a better price. So because you don't know the motivation of these people, you should not be following these programs. This is not where you should be getting your information about what's going on in the markets. That's why we produce a weekly newsletter to provide objective perspective on what's going on, and we discourage people from actively following all this nonsense that's going on.
Oh, that hurts my old feelings, John, because, I used to be a financial news reporter. So, I feel like I should disqualify myself from the podcast here.
we know you, Bill. You always had good intentions. You just didn't know the intentions of your guests.
I just didn't always understand everything. So. Hey, really quickly, economy. Let's talk about the economy really fast, because it ties into your earlier comments about the Fed and what the Fed may or may not do, or how far they may or may not go. What are you seeing in terms? Because we've got some funny numbers in terms of the employment. The latest unemployment report in the United States was, as you know, weaker than a lot of people had anticipated, and it did make the Fed look like, hey, maybe you guys are a little behind here. Maybe you should have gotten in front of this a little bit more. What are your thoughts?
Yeah, well, first of all, let's back up a little bit into the whole shutdown of the government. That really created a lot of confusion, because now you're getting data being released from the period during the shutdown now, and you're also getting on top of that current data. And that's just, now it's a potpourri of information. And so it's very difficult to sort through all this nonsense and say, what's relevant, what's not relevant, what is ancient history now, what is current. The unemployment data, or the employment/unemployment data, came out this week, and is it half full or half empty? It depends on your perspective. I think if more people are in the job market looking for jobs, that's a half full perspective. If you're looking at the unemployment rate, it's slightly higher. You know what? Here in Canada, we die to have that unemployment rate. Our unemployment rate is materially higher than that. So we're very envious of your low unemployment rate and likely about to improve unemployment rate. So I think if you understand that in a new administration, whenever the U.S. Votes in a new administration, the first year, the new administration is always going to make a lot of significant changes in order to implement their agenda. Regardless of who whether left or right, doesn't matter. There's always big changes in year one. And so the impact of those changes will be seen in year two. Now, if the changes are good, then we're going to have a great year two. If the changes are not good, then you're going to have a weak year two. I think every administration, left or right, has good intentions to try and make things better.
Of course.
unfortunately, there's a lot of ideology involved, and there's an ideology as to whether the government is there to solve the problem or if the government is there to create the problem. And so one group believes one thing, one group believes the other. I'm of the view that the freer markets are, the better markets perform, whether that's the stock market or whether that's the economy. So anything that's going to allow more freedom in economic activity, I think, is beneficial. A lot of the changes we've seen in the One Big Beautiful Bill, which is now law, are going to make markets more efficient and a little bit freer than they were previously. And I think that's a catalyst for an incredibly strong economy. I liken it to 1983, a big tax cut implemented by the Reagan administration, and the economy just absolutely took off. And it was a tremendous run from 83 till 88. So we see some very good things going on. We believe.
Hold on.
Scott Bessent. Sorry, go ahead.
Before you get too far ahead, you haven't even answered Bill's question though, which was to comment on the jobs report itself. And so the jobs report itself, although it was portrayed as a negative, was actually not that bad if you look under the hood in terms of the underlying numbers. So unemployment rate came in higher than expected at 4.6% versus 4.4%. But what a lot of people don't understand is the unemployment rate also reflects it reflects people who are unemployed and looking for jobs. So you cannot just be unemployed. You have to be unemployed and actively looking in the last year. And so if you actually look at the number of jobs that were created, it's surprised to the upside. The non-farms payroll was 64,000 compared to 45,000 expected, which means that more jobs were being created. And so what this unemployment report might represent, and this is where, my dad's comment about the government shutdown muddying the waters makes things a little bit more difficult to parse. But what it likely means here is that the economy is starting to grow and people are starting to see that there is underlying growth in the economy. And so they are more willing to then actively look for jobs in the expectation that there are going to be more opportunities available in the near future. It also, if you look at the hourly wages only went up by 0.1% compared to the expectation of 0.4%, which is good from an inflation standpoint. So if people who were worried about, a weak jobs report or wanted a weak jobs report so the Fed could have more reason to cut, the other issue might have been, well, if wages increased more than expected because we had more jobs created, then that would offset and the Fed would have less incentive to start cutting. But the fact that wages only went up 0.1% shows that inflation is still, as we've been saying for a long time here, inflation is still largely under control. It is not a concern. It is not a major consideration that the Fed should be worrying about. Their primary focus should be on maintaining full employment. And as such, it probably means that there's going to be more incentive for the Fed to start cutting rates in 2026, or continue cutting rates, I should say, in 2026, especially if you consider the fact that the Waffle House manager is going to be on his way out and at the end of Q1 or beginning of Q2.
For the uninitiated, that would be Jerome Powell.
So let's talk about the catalysts ahead. Let's talk about, John. What is it, John and Alex? What is it about what's coming in the United States? You've alluded to some of this, John, but what is it that you see is going to drive what you expect will be a good economy in the year 2026?
Well, there are a number of things. The One Big Beautiful Bill has a series of measures that are very stimulative, and they're stimulative in the sense that rules are changing to allow private industry to function more efficiently. So deregulation is huge, and deregulation is going to encourage more energy supply. It's going to encourage more housing supply, both of these things. And we've already seen the initial benefits of the increased energy supply. Gas prices in the U.S. have dropped off the table. Their West Texas Intermediate crude is down to 50 odd? Is it around $50?
55, mid-50s.
Mid-50s, yeah. So it's dropped significantly. And remember that energy prices feed into all other prices because you have to move things around to get them to their destination.
Amen. Yep.
Yeah. So this is already disinflationary. A disinflationary development with oil prices coming down. Now you're going to see, as we said, expansion, more energy expansion. You see more land potentially being released by the federal government, reducing the regulations around permitting for building homes and rental supply. And so all of these things are going to filter through the economy into lower prices potentially. Not necessarily lower price, at least a disinflationary environment for housing. Certainly the inflation in housing that's on the stats right now is going to roll off in 2026. And so we should see a big drop in the inflation rate from that alone. Now, you also have some retroactive tax cuts. So the bill was passed on July 4th. Certain tax cuts were retroactive to January 1st of 2025, yet there was no payroll adjustment by the IRS or by companies for the withholding taxes. And all of that is going to find its way into the system starting January 1st, 2026. So now people's paychecks are going to go up by the amount of tax cut that's affecting them. They also are going to get big tax refunds in the spring for a similar reason. And so you're going to get some nice gradual boosting in Q1, and then you're going to get a big boost in Q2. And then there's this whole tariff revenue potential. As we know, the Supreme Court's taking a look at the authority to charge these tariffs. And there is a possibility that they move against the administration, but the administration has other tools at their disposal to try and continue the tariff regime. However, should they rule in favor of the administration, what we're going to see is all this money that's come in, a portion of it's going to be used to refund to the lower 60% of the U.S. population in terms of income. And that could translate into a one-time check of $2,000 or $2,500, which makes a huge difference to people in the bottom three quintiles of the U.S. population, because many of them are living paycheck to paycheck. So between payroll tax cuts, tax refunds at springtime, and a potential for this additional one-time payment, that is a huge private sector stimulus. Plus, and so the argument is made by the people who oppose that strategy. Well, yeah, but that's going to be inflationary because now everyone's going to have more money in their pockets chasing fewer goods. Well, the whole concept of supply side economics is not to have fewer goods; it's to have more goods, to increase the supply. And so you're not going to get an inflation. And the Fed has other tools at their disposal to offset any cuts in interest rates. So we see a virtuous cycle unfolding gradually in 2026 among the things that I've mentioned. But there are other items. Alexander, do you want to step in with supplementing that information? Do you want me to keep droning on?
Oh, well, you can keep going if you want. What were you specifically thinking about? Were you talking about the deductions, like the SALT deduction cap?
There's the SALT deduction cap, state and local taxes adjustments. There's the depreciation of capital assets. So depreciation, instead of being written off over or any major machinery and equipment being written off over 3 to 5 years, is now going to be written off in year one. So that's encouraging expenditures by corporations.
And I think people don't appreciate how massive that is.
I know nobody cares about my opinion here, but I do have to tell you, I live in a very high tax state. And so the SALT deduction.
Why have you moved to Canada?
Oh, God. I'm close enough we could be your cousin. I live in the state of New Jersey. So it'll have a massive impact on states like New Jersey, California, Illinois. I'm mixed about SALT deductions because I don't like the rest of the country subsidizing my government's will to spend money they don't have. But I do really, really like the 100% deduction of capital assets. I think that is a banger of a deal, gentlemen. I think it's great.
Yeah, because what it does is it encourages companies to bring forward investment in and capital assets and infrastructure, which will allow them to become more productive. What it does is and so to go back to the point earlier about the extra money in people's pockets being inflationary. Well, if you're encouraging businesses to produce more, whatever it is that they produce, more products, more services, by allowing them to invest more efficiently or cheaper in their and whatever infrastructure they need to produce their goods and services, then that creates jobs. Then that also creates products for those dollars to then chase, or services for those dollars to chase. And so what you're doing is you're growing the economic pie that everybody is going to be eating from. And so the fact that people are going to have more cash in their pocket due to lower taxes and a refund that's a result of the tariff revenue that they've brought in, that is going to now be chasing not the same amount of goods and services, but more goods and services. And so it will not be net inflationary, and it will be incredibly stimulative to the economy, as will the $10,000 deduction for interest on American cars. So you are going to be encouraging people, again, to invest in American-made automobiles, which will then create more demand for the American auto industry, which has been reshoring a lot of their manufacturing back into the United States for people here who live in Canada. And I understand there's a great deal of frustration in Canada about that, because it means that some of those jobs are leaving Canada and going to the United States. But for the American investors and the American economy, that is going to be incredibly stimulative, because now you're encouraging more of that manufacturing to take place in the United States, more people to buy American-made cars, so you're increasing the demand for those products, which is going to, again, create more jobs, more goods and services that are available, more people with discretionary capital to then spend on other areas of the economy. And so those two items are kind of under the radar, less headline-worthy cuts or stimulus packages that are part of that big, beautiful bill that doesn't get talked about as much, but can have a massive impact.
And speaking of discretionary expenditures, we haven't even discussed the fact that there's going to be no tax on tips up to a certain level, no tax on overtime, an offset for Social Security in terms of taxation. So people are going to have more money in their pocket through 2026 from all these measures. I can't emphasize enough how revolutionary this bill has been to the potential for the U.S. economy. Not since the big tax cut of Ronald Reagan in the early 80s has there been an administration in power that is very pro-economic growth in terms of their mandate, but through the private sector, not through the public sector. And you know, there are people who disagree with this viewpoint, but keep in mind that you can disagree all you want. There's a constraint on public expenditure. You can only borrow so much. You can only tax people so much before they leave. We're seeing that in the U.S. in terms of internal movement from blue states like California to red states like Texas and Tennessee and Florida. So when you tax people beyond a certain level, they just get up and they leave. And in the case of other countries like us here in Canada, we don't have an alternative province to move to where taxes are lower. We have to leave the country. And there has been a net exodus from Canada over the last decade as job creators and high income earners have said enough. So then it falls upon debt, and then you have to borrow to spend the money if you believe in public expenditures versus private sector expenditures. But even that has its limits, and we're approaching that limit. There's a lot of noise going on here in Canada with the Parliamentary Budget Office. That is saying, you know, they can't keep this up. You have to have some changes, and same thing in the U.S. So,
to which they responded by firing the budget officer, the parliamentary budget officer.
Yeah. So the parliamentary budget office is the equivalent of the congressional budget office, which is supposed to be nonpartisan, of course. So alarm bells are ringing about the amount of public debt, and so. You know, interestingly enough, we had an election here in Canada. We're going to cover Canada in a second, so maybe I'll park that thought until we get to that point. So in terms of the U.S., we have a lot of beneficial things unfolding. We also have some potential disruptions. It could be another government shutdown on the discussion over Medicaid, over Obamacare, which was never a successful program to begin with.
And I want to just get in here because this perspective does not get put out nearly enough as it should be. One of the things that I don't think anybody understands, including the media that's covering this story, is that these sunsetted subsidies for Obamacare programs, or the American Care Act, the ACA, were sunset provisions passed by a Democratic Congress. These were passed by Democrats. So the fact that they now find them objectionable and are trying to blame Republicans for them is ironic. I guess we'll try and leave it at that less pejorative language. It's a bit ironic. But you're right, John. There is a battle coming up, but that's a long time coming because they're both in Canada and the United States. There needs to be a really serious discussion about healthcare, and maybe this is a catalyst for it. I don't know.
I don't know about the U.S., but there's never a serious conversation about healthcare in Canada. It's the third rail, and any politician who attempts to touch it gets zapped immediately with a burst of electricity. So. Down in the U.S.,
it's an inevitability, though. No matter what,
and I think it's inevitable because anybody who's been listening to your podcast, guys, know because you've had people come on and talk about the unsustainability of the subsidies in Canada. We'll get to Canada in a second. I'm sorry, I'm jumping ahead. And they know that there's a doctor shortage in Canada. They know there are things that are happening in Canada. So that John, I would argue that maybe it hasn't been, but maybe on both sides of the border, finally. People will be forced into that conversation.
As far as the United States is concerned, I think someone needs to clearly articulate that the whole Affordable Care Act was flawed from the outset. It's turned out to be far more expensive than they believed it to be. And the subsidies that were brought in during the COVID shutdown were temporary in nature. Yet the Affordable Care Act continues to increase in their premiums and trying to keep something that is bankrupt going with government subsidies makes no sense from a business perspective. What's ironic
is John Fetterman, Democrat congressman or senator,
Senator
from Pennsylvania.
Yeah,
he came out and he said, kind of scratching his head and saying, I don't know where all the rhetoric is coming from, because these were always, he was around when this was all put into place, and he said this was always designed to be a temporary measure. This was never designed to be a permanent subsidy. But anyway, the whole point is that this has the potential for another government shutdown in the new year if they choose to drag out the funding crisis again and refuse to fund the federal government if they don't extend the subsidies. And so there will have to be a resolution of some sort that needs to be put into place. But that is a potential, dark cloud that's hanging over the economy and the financial markets as a result, as is the potential of what happens with the rate cuts. Go ahead.
There's also waste, fraud, and abuse that's trying to be rooted out of the system in Medicaid and SNAP and other government programs. And so there's going to be a battle there with the opposition in the U.S. government. But moving on a bit from this topic, we're going to have midterm elections next year in the United States. You, Bill.
Yep.
And so a lot of the measures that were implemented by the current administration will likely materialize. The benefits much of the benefits should materialize before those midterm elections. And if they do, then there's the potential that the continued growth-friendly agenda continues in the United States. We also see in the stock market, as far as the stock market's concerned, the Japanese carry trade unwinding, and what that means in plain English. Interest rates in Japan were so low for so long. A lot of hedge funds would borrow money in Japanese yen and then invest the money in U.S. tech stocks. But with the new Japanese government, interest rates are starting to come up. Dare I say, to normalized levels. I don't know what's normal in Japan. I mean,
normal is they've been at zero for so long. They were negative, John.
Yeah, they were negative for a while. So anyway, that's having a negative impact on the technology sector in the U.S. And we also see some. It's that time of year where people are projecting where the market's going to be a year from now.
Yeah.
I don't like participating in these projections because I don't think anybody really knows. I mean, you can easily apply a 12% increase in earnings. In earnings growth, which seems to be an acceptable number. So if you just apply that to the S&P, you're looking at S&P roughly 7,500 ballpark. Others have numbers greater than that. My projection is I don't know.
And a fair one at that. But we cannot get out of here because we've alluded to this several times. We've talked a lot about U.S. We've talked a lot of catalysts, a lot of risk in the United States. But we can't get away from talking about Canada, and we need to talk about Canada. So what do you see happening in 2026 for Canada, and what's your outlook?
Well, not as optimistic as we are in the United States.
Not even though it would seem that your recently elected regime has had to modify a lot of the stances that it took during the election, and it seemed to be pivoting more toward the energy sector. What?
Let me, before I begin to answer, I want to be clear. Canada is a country of enormous natural wealth.
Yes,
it's a country that possesses immense intellectual capital and talent. Tremendous entrepreneurial spirit. Canada is a country that economically has the potential to not only remain in the G7, but move to the upper levels of the G7 in terms of economic prosperity. So I'm not negative on Canada in terms of the people or the natural resource wealth that we possess. However, the political regime, despite the election we had in the spring, remains to the left of the political spectrum. It remains very much ideologically driven by climate alarmism, and we're not gonna get into that debate about the climate, but suffice it to say that the path that the previous Canadian government had and the current Canadian government in terms of stopping the extraction of our natural resources is not materially different. I think the changes that you alluded to are around the perimeter, but not really major changes.
Not substantial.
And the government said they're going to increase the housing supply. Well, as Milton Friedman said, if you gave the government responsibility for the Sahara Desert in 5 years, there'd be a shortage of sand. So to expect the Canadian government to resolve the housing supply, we've been building a crosstown transit system in the Greater Toronto area for about 12 years now. Alexander, do you remember when it was started?
It's 20.
No, I don't think it's quite 20. Anyway,
2006. Look it up.
Wow.
It's 2006 was when it started.
The level of incompetence borders on Gavin Newsom's bullet train in California, which to this date still hasn't been built, and has an eyesore on the California terrain. So to expect that the housing shortage is going to be remedied by government spending is not a good expectation. We're going to take on more debt. They're using creative bookkeeping with respect to our deficit and debt. They're saying, well, we're going to try and eliminate the deficit. They have no intention of trying to fix the debt. They are unlikely to have a balanced budget for years into the future. Really, nothing has changed. Our current leader, like the last leader, is still hell-bent on deindustrializing the country for the purposes of avoiding a climate catastrophe, which, interestingly enough, one of the leaders of this subject matter, Bill Gates, about a month or 6 weeks ago, came out and said, there's no urgency. Yeah, there's an impact on the climate, but it's not an existential threat, and we should really reroute our resources toward other areas of need. And the media hasn't taken that and run with it. It just kind of fell by the wayside. But that is huge because Western Europe, especially Germany, France, the UK, they've been in the process of deindustrializing for the last 15, 20 years, and their economies are a mess. And
the German economy just announced not the German economy. Volkswagen just announced it was going to shut a factory in Germany, which I think is a first ever for Volkswagen.
That's well. Speaking of companies and shutting down or moving, let's look at the country of California, which is one of the largest economies in the world, and on par with many other countries. They've been on the deindustrialization for the climate existential threat for the last 30 years, maybe longer. And now Chevron announced they're moving out of California, a company that was founded in California in the 19th century. Phillips 66 is closing down operations. There's another oil, Valero, is closing down operations. Everyone's moving to Texas and other locations. And so no matter, and the irony is California is now going to be relying on Saudi Arabian oil and gas shipments to power them. So really, have they made an impact on the global climate because of their economic policies, or have they just redirected that drilling and extraction and oil production to other geographies, but on a net basis around the planet, nothing has really changed. So California is destroying itself economically in pursuit of this ideological objective, as Germany has been, as we have been here in Canada. So I'm not optimistic on what's going on in Canada. We just hope enough entrepreneurs and enough capital remains in our country so that our economy can continue to trudge along until new leadership comes along.
Well, I love Canada. I mean, I do genuinely love Canada, and it's like I want nothing but the best for you and for your country, because I think everybody's better when we've got an economy north of us that is strong, is thriving, and is doing well. And I would like to be optimistic. I'm not feeling very optimistic, though.
No, and there are a lot of informed people in this country. There's a lot of people, business people, academics from economic think tanks. They've all made themselves very clear to the government that the model they've been basing their decision making on for the last decade or even longer potentially has been wrong, and it has to change. And we're going to have we're already in I'm saying we're going to have we're already in an economic crisis. The people of Alexander's generation can't afford housing. And the same thing's going on in the United States. They cannot afford housing for a variety of reasons, housing supply being one. But also the fact that a lot of these jobs went to China and other parts of the world, and they did not, a lot of the same problems that the U.S. had, but is being addressed at the present time. We also suffered from those similar problems, getting rid of our supply chains to foreign countries. And we've also been ideologically driven to make sure everyone has a university degree in, you tell me what useful subject matter. And so now you have a bunch of university educated people that don't have the skill set that applies to the current economy and the technology, the AI unfolding and innovation. So yeah, we need to make some changes here in this country, but I don't know when the next election is going to be. And that being said, you can still make money in the Canadian stock market. There are good businesses still here. Most of them are in the financial services, insurance companies, banks. There's a lot of good energy companies if they decide to stay. Gold mining is huge. Obviously, there's been a big drive toward gold in the last few years, and Canada is one of the biggest homes to gold mining stocks. So there's still opportunity to make money in the Canadian stock market, and we do have a Canadian model that we manage. So yeah, there's still opportunity to profit. But in terms of employment and housing and all that, I don't see much improvement in the near future.
Well, John, we can't end on that note.
You know what? Here's a positive spin, and that is, I often say to people who say that we need more regulation because we can't allow greedy companies or individuals to go without restriction. I've always said that the best regulator is competition. And you noted earlier, Bill, that Canada seems to have moved off a little bit from their prior trajectory under the new government. And so the fact that there is this competition coming from the U.S. and from other parts of the world, although it's principally coming from the U.S., I think that competition is eventually going to translate into a directional change for our government. So I think there's great potential, and it's right now it's happening on a small scale, but inevitably, I think the competitive forces will force our hand.
Very good. Let's hope so. Our competition's good all the way around. Strong believer in it. Competition sharpens each other, and
absolutely.
If there's, what the other thing is too, Bill, to further dive in on that, the Bank of Canada has said that their plan is to pause fiscal stimulus for now. They've left it. They believe they're at the bottom of their, neutral policy range where they currently are right now. But the thing is that the United States Fed is likely going to continue to cut into 2026. Right now, the market is pricing in 2 more cuts. They recently resumed. They're not calling it quantitative easing. They're calling it balance sheet management and liquidity management. But at the end of the day, it's a little bit of semantics there, because it's quantitative easing where you're worried about the liquidity that's existing in the market. You're saying that the financial system is starting to grind itself down to a little bit of a standstill, and you're needing to inject some lubrication in there to get the gears turning. And so that likely all points to the fact that there's going to be further cuts in the United States. And if that continues to be the case, there will be pressure on the Canadian the Bank of Canada, I should say, to enact some further rate cuts into the, if we're not calling it Q1, probably Q2 or Q3 of 2026 as a result of what's going on in the United States, as well as the fact that we don't right now, there are no positive or no major positive catalysts for our GDP growth here in Canada. And so it's unlikely our GDP will be stronger now, given the current trade situation that we're facing, and the fact that the GDP is already in a position where it's approaching stagflation territory. So there's likely going to be a need for further stimulus, and that may hopefully spark the economy and spark the Canadian market to go on a bit of a run and create some opportunity for some growth in the Canadian market. So that would be another positive take on what might happen in 2026.
I know. Let's hope so. My fingers are crossed. All right. Well, with that, we've come to the end of this particular episode of the podcast. What have we got coming up in the next episode?
Next episode, we're going to be speaking with a former colleague of ours, Randa Chowan. We're going to be following the money and the narrative in the financial, and navigating the narrative in the financial media headlines. And so a lot of times one of Randa's big items that he likes to talk about is you got to follow the money. You can't listen to the noise. You got to look at what's happening behind the scenes and behind the curtain if you want to get a true perspective as to what's going on. There's a lot of flashy headlines that we get inundated with on the media, social media, and every other news outlet that exists. And his MO is trying to find out what's going on behind the scenes. So it should be a very interesting discussion.
Look forward to that. In the meantime, before we get out of here, if anybody's listening to this podcast and they want to get a hold of you, how do they reach out and maybe request, John, it's worth repeating, if they want to request that newsletter where you compare the George Mason University argument versus the MIT argument, what is the best way for them to reach out to you?
The best way is to send us an email at info@medwealth.ca or visit our website at med-wealth.ca.
And if you do send an email, do request that particular newsletter. It's good reading. John does a good job breaking it down. So the other thing you can do is, if you're listening to this podcast and you're not a subscriber, hit the follow button. Become a subscriber. That way you won't miss the next episode. You don't have to worry about when or where you heard this one, because you'll be notified when the next episode is released. And do give us a like and tell people about this podcast. Tell them you like it. Word of mouth promotion in the age of the bots, another human talking to another human is irreplaceable, and we really, really do appreciate it. So until next time, I'm Bill Tucker on behalf of John, Alex, and everybody at MedWealth and the folks behind Prescribing Prosperity. Thanks for taking the time to listen. We'll catch you the next time.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.